What is going on, Hot Take Nation? It is DRW here for another episode of the Hot Take of the Day podcast. I am your host. Obviously, I control the mic and I control the topics. We have a lot of fun, and one of the ones I was excited about having when the press release came out last week was Rob McBride from Enverus. So first of all, Rob, welcome to the show. I'm going to give a brief intro on what we're going to talk about.
Great. Happy to be here.
So if everyone will remember my blog in probably late August or September, I entitled it Natural Gas Burnout. And the primary concept was, with the rig activity that was going on in the Marcellus and in the Haynesville in particular, they were the only two plays that, in my opinion, were actually improving the productivity and the EUR per foot, which to me is the only actual measure of economics. This IP rate is garbage. Nonetheless, we looked at it and we said, with what's going on in the Marcellus, with what's going on in the Haynesville, with what's going on with associated gas, we're having to export more and more gas because our market was so saturated, and that with things that were going on in Europe, there was a massive bear case for natural gas. And I think through the winter and into early March, we saw that gas was trading as low as $1.60. It was a disaster. Then March 6th, Russians say, OPEC, not so much. Saudis, March 7th, say, I see your OPEC not so much, and I raise you. I will add 2 million barrels a day to the market. March 18th, lockdown happens in California. The 20th, the lockdown happens in New York. And the next thing we know, world oil demand falls 35 million barrels a day. Oil trades at negative $37 a barrel. And ultimately, what we would project is that 3 to 4 million barrels a day of crude are coming off the market. Now, that sets up, on an average GOR of associated gas, 12 to 20 BCF a day coming off the market, which is bullish for natural gas. Massive surprise. We saw the natural gas equities outperform, the oil equities underperform, and Rob McBride is here to talk to us about the bull gas thesis with the Haynesville and the Marcellus. Rob, how did I do for a 2-minute intro on how the world changed so much in the last 9 months?
I would have to say you came pretty close to nailing it. Couldn't have said it better myself, and I think you touched on all the hot points there. The one thing I would add is, when you were going through the sequence of events in March, yes, we do find that we've developed a bull case for natural gas. It didn't come immediately. Natural gas industry took its punches on the chin just the same, and they're starting to recover from that. But the balance of 2020 was still very, very, very difficult for all the reasons you mentioned, plus the demand destruction due to the pandemic. However, that does set us up for a very bullish 2021.
So let's talk about that. Where do you want to start? Do you want to talk about demand destruction and what we've seen in recovery? Do you want to talk about the performance and what you're seeing in the Haynesville and Marcellus first? You tell me where you want to start, and we'll go there.
Yeah, sure. I think actually the best place to start is the oil story. And so you go away from those dry gas plays, but think about the Permian in particular, but any oil play, all the associated gas that had to come off the market when the oil was shut in. That was the villain as far as the dry gas producers had been battling for many years. So that piece of supply was taken off the market, and it not necessarily has any reason to come back immediately until the oil demand returns. So when that part of the supply was taken off, it then brought you back into the scenario, well, where are you going to get the gas? Because come winter, the demand is coming. And plus, I definitely want to touch on the fact that you mentioned what was happening overseas. Europe was in a very oversupplied condition. Then you took demand off the market on top of that. That destroyed LNG exports this summer from the U.S. It was one thing nobody ever really even knew how that would look. When this export terminals were built, they were all backed up by take-or-pay contracts. No one really anticipated what would a cancellation look like. Well, we've now seen that, and those exports got decimated, but those spreads, i.e. the net back to ship overseas, is back. And those exports are rising again. So if you couple that with the expectation of you have to at least assume a normal winter, obviously that's a wild card, but if you assume a normal winter and normal exports, Well, the U.S. looks pretty short in natural gas, and it's going to have to turn to those dry gas plays until those associated oil plays come back online, and that makes us focus on the Haynesville and the Marcellus.
So when we think about short and long, I mean, where would you say the inventories for natural gas are relative to historical? And you know, I mean, I think back to the beginning of my career in like 2000 and the Senate hearings in the United States that talked about the shortage of natural gas, the way Aubrey McClendon really pushed demand by pushing out coal, because he was actually the first to really talk about the CO2 narrative around coal to prevent coal plants from being built. Natural gas obviously was scarce at the time, and then we went horizontal, we started fracking, and we ran up to 10 and then came back. Yeah. Are we really short in natural gas, or are we short in natural gas given that gas has been $2.50 for the last 3 years and that there really hasn't been a lot of justification to drill it and complete it other than in the Marcellus and Haynesville?
Yeah, I mean, I think the tricky thing with natural gas, it's not tricky, but the one difference between that and the oil markets is this: when we talk about short and long, every season is a different story, right? So that's exactly what we were just talking about. The balance of the summer and into the shoulder season, we do still have a potential to hit the upper limits of our storage capacity. However, in a normal winter scenario, with exports going, you very, very quickly clear that storage overhang because supply is still down, so that those associated gas plays are offline. We've probably returned in our shut-in wells, but the activity has slowed down, so the natural declines is starting to catch up with us as winter is coming, and your exports are starting to pick up again. So therefore, for this season, you look very short, quote unquote, just because that activity to produce the replacement gas for the natural declines hasn't picked up yet.
So let's talk about productivity. And I always think about the Marcellus, because in 2010 we were effectively 0 MCF a day from horizontal Marcellus wells. And if you include the Utica and the Marcellus together, I think that the total production peaked at close to 35 BCF a day 10 years later. So what are you seeing in the Marcellus and with activity and with operators? And let's start with there, and then I'll follow up.
Sure. Yeah, we've continued to see year after year, just like you said, activity just comes in. No matter how low prices went, the operators figured out a way to be more efficient at lower cost and continue to just march towards record levels. And we get up to that 35 BCF a day number in that neighborhood that you're talking about. At this stage, we would say your dry gas break-evens are still probably anywhere around $2. Some of the core plays you can do, you can break even below that, but think about somewhere in the low $2 is your range. Now, compare that to an associated gas play where the break-even for gas is basically 0, right?
Right. I always called it, when we were at One Energy, people always got mad, but I said gas is a waste product for us. And if you can get rid of it and we got nothing for it, that would be totally fine.
Yeah,
and
that's
obviously,
a benefit.
I don't support flaring by any stretch of the imagination, but in the Permian, the driver was oil, not gas, and there just wasn't enough in a well to really move the economics. And so you're saying that what you see in the Marcellus is about a $2 break-even supply cost, and that's to return a 10% return at current costs for a given performance in, are we talking tier 1 inventory?
Yeah, we'd be talking tier 1, although we would actually say you could get close to a 20% return. We've sort of switched our modeling to focus on that. We think in these days of demanding free cash flow, operators really are more, we used to use 12.5%. We've upped that to 20% for our break-even analysis. And in that $2 range, tier 1 acreage in the Marcellus Utica can deliver that return.
Which is truly amazing, because I remember back in 2012, just before the crash, and the price decks that a lot of people were using for the Ever was $90 oil and $4.25 per MCF gas, because,
Sure.
obviously costs were high. The Bakken really was one of the only developed plays along with the Eagle Ford. We didn't have economics in the Permian, and the Marcellus was starting, but I don't think people really understood the scope and scale and how much technology would improve. And by that, I mean better frac technology, but also lower cost, faster wells. To move the break-even supply cost to $2 is truly amazing to me.
Yeah, I mean, it was every year, like I said before, the whole industry was wowed at how do you keep producing this product as prices keep declining. We call those numbers, and we'll even use that at a $40 oil price deck. Obviously, in the Marcellus, it really doesn't matter. Your break-evens don't shift as much with the oil price as they do in the oily plays. But yeah, that is what we look at. We do a 20% rate of return, $40 oil deck, and you're probably in the low $2 for the core parts of the Marcellus Utica.
So let me ask a follow-up question to that, which relates to what I led with, which was the Marcellus and Utica grew from 0 BCF a day to 35 BCF a day. Now, we all know that the midstream business model is predicated on growth. And to guarantee their returns, they would have companies to build that infrastructure sign very, very long duration take or pay contracts. And so one of the drags on natural gas players in the Marcellus in particular was, with this growth, you far exceeded the capacity to manage gas. And I remember at the time there used to be a premium to Henry Hub because there wasn't enough gas in the Northeast. And for a while, and I haven't checked recently, but it actually went to a discount because there was so much gas you couldn't get it out. But with these take or pay contracts and this midstream overhang, how much does that negatively influence companies if they're 2 or 3 years behind their growth plan after having 1 year of just like no free cash flow, massive debt, bankruptcies, restructuring? Well, what's the burden that you see of these take or pay contracts, and how do you value that in the break-even supply cost?
Well, what we would say, I mean, our break-evens, let's start with that. Our break-evens we talk about at the wellhead, and then it gets to be a much more complicated story after that. Can you get it to market at a reasonable rate? So exactly like you talked about, over the decade, it was actually a roller coaster of, the premium went away very quickly, but the discounts were massive, literally similar to what we saw last year in the Permian. There were points where it was trading, at least on the day, very, very, very negative because of the capacity constraints. And as you know, the big effort to turn around the long-haul pipes that were traditionally going Gulf Coast to Northeast, turn them around. Those projects went underway in full force, started to bring capacity looseness to the region. But again, the operators were able to continue to raise capital and just continue with their drill plans and bump up against the capacity constraints. So we still face that. Now, as of today, especially with the pandemic, the region does have spare export capacity, but at the rate we expect it to continue to grow, there were 2 major projects on the ballot, so to speak. One has been canceled and one is continuing forward. The Mountain Valley Pipeline should continue and begin service in 2021. And the Atlantic
how much
Coast
how much capacity will that add to the region?
That's 2 BCF a day. And I think if you get that, and you should, you're probably good into 2022, 2023. However, if that were to get canceled, and the reason people talk about that is because its sort of mirror pipeline was the Atlantic Coast Pipeline sponsored by Dominion, was just canceled even after they sunk $3 billion into development. They just didn't go any further. And that pipeline is not going to get built. It was basically the same size, generally the same direction from the Appalachian Basin into the Mid-Atlantic, Virginia region to hook up with Transco in that area. Anyway, that one's canceled. And therefore, a lot of people wonder, well, will the same fate happen to the Mountain Valley Pipeline? Well, arguably, because it's serving the same purpose, the same resistance would exist in the market, but it is almost complete. So we do not handicap that at the same risk of getting canceled. And where I'm going with that, if that were to happen, as early as next year, the Marcellus could be in the same constraint scenario it experienced over the last decade. We don't expect that. We expect that pipeline will get completed. We're looking at possibly 2023 where you bump up against those constraints. But it's a nonstop problem. As long as the core acreage is there to continue to grow production, the pipelines seem to always lag the rapidness with which the production comes online. But I think with this large project being completed, you're going to look at, you probably have some breathing room until 2022, 2023.
So it begs a lot of really interesting questions. So again, growth, and I think we've all seen it, right? In order for you to raise capital in the world, you must be a growth industry. Even if you're not a growth industry, and I would use WeWork as my favorite example, they called themselves as like they tried to be a software as a service, like the SaaS, but they called it like space as a service to try and give themselves this techie buzz. And Tesla sells 500,000 cars, but apparently Elon's brain is worth like $300 billion. But everyone has this growth narrative. The growth narrative is the single thing that undid the oil and gas world. And in particular, because they never issued equity, they only used debt, the economics never truly justified the amount of growth that was occurring. And yet what you're telling me is, even after all of this and all of these learnings and all of these constraints and all of this free cash flow demands, the Marcellus is going to resume growing at the previous pace such that it's going to outgrow its infrastructure. That feels bizarre to me. Is it that good? Yeah. Is it that big and that good that it can just, we have all the gas in the world and they can just turn it on?
No, I don't think it. I think you're hitting the nail on the head. There's one big caveat that this story will rely on going forward, that it didn't necessarily have to, because I think capital was much more easily accessible in the past decade than it will be going forward. This story relies on global demand increasing, right? This is an export story for the U.S. We do have the argument that there will still be continued coal to gas switching. So there's a little bit of growth to burn more natural gas in the electric gen industry. But honestly, that story is running into, particularly in the eastern US, particularly in the mid-Atlantic areas, it's running up against, like it or not, a huge political backlash of, do we really need to switch to gas, or can we go straight to alternative sources, right? Obviously, we could spend hours debating that. But the growth for the play in the Marcellus Utica region heavily relies on the rest of the world continuing to demand natural gas. Now, where is that? That's particularly overseas through LNG and also Mexico. We do have spare capacity. We can export this right across the border via pipeline if their infrastructure demands it. And really, if you look at the emerging world, India in particular, if those economies are going to increase over the next 2 decades significant amounts of natural gas consumption, then that's where the Appalachia story is going to fill that void. We'll continue to burn it here. I think our very small growth in demand, maybe 1 to 2% domestically. The continued growth of Appalachia heavily relies upon global demand growth for LNG.
So I love that as a conversation, because so coal, a lot of CO2, we're worried about emissions. We have this concept of straight to solar, straight to wind, it'll be great. We've seen what's going on in California with rolling blockouts. We've seen that sometimes the wind doesn't blow and the sun doesn't shine. And that's not an excuse that we should never have that power. But for example, I talked to Jack Hamlin from Energy Strong, and one of the things we talk about is Boulder has the highest energy consumption per capita of any county in the entire country. And they have an unbelievable amount of land, and yet they really don't have any wind and solar, and they use other people's. They import a tremendous amount of energy. Are we seeing in California, and with our aging electric grid, are we seeing that it's really a good idea to just go to wind and solar? And on that note, my understanding was there's a lot of natural gas store capacity where we have extra power plants that we can surge on and off, but that generally we have a lot of capacity that's unused. Is that true? And if so, do we really think that we should be building new electric generation versus maximizing the capacity of our existing stuff? What's your opinion on that, and how much work has Enverus done on it?
Sure. Lots to unpack there. So, but let's just start with California because it's the headline of the week, so to speak. You're hitting on all the right targets, and people are asking the question, wow, did you do too many things at once? Bring too much renewables online, take off your natural gas units at the same time before you actually were able to guarantee that the system could survive. The devil's probably more in the details. There's probably more nuance to it. For example, there's probably a lot of policy decisions that aren't done correct. The actual structure of the way the ISO is managed to bring the right resources online at the right time, that's where those questions you're asking are, were there actual spare units that weren't even running, even though we're doing rolling blackouts? There's a lot of nuance in a power system design that actually will address, well, was it actually, is it just, a zero-sum game? Do I have the capacity? It's having the capacity in the right location, being able to ramp it up and ramp it down in the amount of time, whereas sometimes the way you pay the cost is a rolling blackout. Take off this one little section of the grid for an hour outweighs the benefit of starting up the one particular gas unit you might have had online. So what I'm doing is throwing just sort of
there's nuance there, but there's
yeah.
nuance. It's complicated to run a grid, and it's not just obviously wind and solar, but it's, do you have it in the right place at the right time for the right people for the right load? And there may or may not have been equipment, but there's some policy decisions politically that probably are undermining the physical constraints. And what we're seeing is the problem with policy, not necessarily the problem with infrastructure, if I paraphrased you correctly.
Yeah, it could be. It could be a little bit of everything all mixed into one. I think the position we would take on it, like for one, it's easy to throw darts at them, but, California's trying to do something that no one else is trying to do. Now, that's going to be having a lot of pain for a lot of people. So I'm not supporting it, but I'm also not saying it's just so easy to just say it doesn't work. At the end of the day, I do think the bigger story is going to be, look, the easy thing to say right now is, well, you really have to wait till electricity storage gets to a more advanced state so that you can have solar and storage, wind and storage. The answer to that is yes, but I actually think the diminishing returns is really going to be over the next decade. The real big story here, and what I'm getting at is getting to 50%, even if you had wind and storage, solar and storage. That's a admirable task. As you try to go to 70%, 80%, 100%, the cost to the entire population, I believe, are going to get exponentially higher. So the technology is not there yet. It's not that we shouldn't try, but we have to expect that getting to that last few percent off, you're gonna look at numbers that are just completely nonsensical for any retail person to be paying. We have to crack that nut, and I think what's going to happen is the policy back and forth will circle around to, yes, we need a mix. The real answer is a mix of everything. That's going to bring nuclear back into the conversation. It's going to bring gas to the table. There's always going to be the demand for that. Doesn't mean we shouldn't try, but the actual exponential cost increase as you try to get to 100%, there's no way I'd see in our lifetime without a healthy mix of fuel sources to provide our electricity.
And you certainly address a point. And what I've learned from the coronavirus lockdown is we're not very good at discussion of trade-offs or future costs. And so it's all well and good for the federal government to print $6 trillion of stimulus. And no one is having the conversation around what does that do for debt? What does it do for the US dollar? What does it do for denomination? What does it do to gold? What does it do to inflation?
Yeah.
We'll deal with that later. But what you've raised is there is a movement to really go 100% renewable regardless of the costs, that there's a whole bunch of policymakers that are launching towards it. And in the event of a Biden victory, I think that that would have a higher probability of happening sooner than later. Now, on that, we talk about natural gas. Is it a problem to the bull thesis that we're relying on exports to rest of the world where there is surplus capacity coming on from Qatar? Saudi Arabia is looking at it, Algeria. There's a lot of flared gas in a lot of parts of the world, and there's a lot of gas that's available out of Russia, out of these places that make gas very accessible. I look at oil, and had we not allowed exports of oil companies would not have had a place to send their barrels. So they would have instilled capital discipline within constraints. But all of a sudden, we put ourselves out to the world. One of the things I've always liked about natural gas is it's fairly domestic. And what you're telling me is the bull thesis relies on us continuing to grow our export capability, which feels like we're setting up for the exact same thing in natural gas as we just saw happen to the world in oil, which is it's a global commodity. And if Qatar comes on with 30 BCF a day from some offshore something, and Israel does what Chevron's going to do with that, with the Noble acquisition, and et cetera, boom, glut of gas, boom, prices hit $1, and everyone here goes bankrupt again. Am I thinking about that too simply?
Well, there's no way anybody could think about it too simply because the question is very complex. And I would agree with your train of thought there. What I would say, the alternative, at the end of the day, the accessible resource that we have so far out exceeds, even our, wildest imagines of domestic demand. So I would answer your question with this. Yes, the capital discipline needs to be very, very stringent. Anyone funding natural gas development should have those questions about, well, is Qatar, is Australia, is Russia, is somebody else going to compete with you so that you don't get to export? How sure are those revenues going to be? The alternative, had you kept it domestic, there would just be that much more capital discipline to know who should develop, because we can only develop so much that we can consume here. And I think either situation, you're relying on growing demand. Where can you grow it? It's probably more likely that you could make the story it's going to grow globally faster than it's going to grow in the U.S.
So let's talk about Warren Buffett, and forgive me if I misquote this, but it was Dominion, I believe, that sold a large portion of their natural gas asset to Warren Buffett. And a lot of people wanted to point to that as the Oracle of Omaha is now investing in gas. That must be bullish. Do you see that sale as that, or was it something more strategic, or how do you interpret that move in particular as it pertains to the natural gas bull thesis?
Yeah, I don't know that it was it's not his first move. So Berkshire Hathaway has been heavily invested in midstream assets in the natural gas. This is a huge addition. It strikes me as twofold as a story. One, what's Dominion doing? Well, Dominion, that sale to Warren Buffett happened at the same time, I think actually the same day they announced the cancellation of their large Atlantic Coast Pipeline project. So Dominion basically is sending the signal, we're going to just focus on our electricity business and we're going to actually become a renewable energy company. Warren Buffett, I think, is just saying, hey, for the right deal, I know these assets actually give me a regulated and almost guaranteed rate of return. I'm going to happily, for the right price, add that to my portfolio because the pipe that's already in the ground. So I don't think he has any aspirations to build new large infrastructure projects, but these pipes are going to be in use. They're serving demand that's definitely here to stay, and if not growing a little. That sort of return is very comfortable to continue to assume. So to me, it was more Dominion's like, we don't want to be in this business. and he was happy to say that's a steady.
It's a consolidation. I can
Yep.
spread my cost structure over something, and it's a win-win for both parties. That's a really
Yeah.
good point. So let's think about the fact that U.S. has a lot of natural gas, and that in order for us to really get the resource maximized, we're going to continue to drill it, and then we're going to export it to other parts of the country, of the world. Which, again, when we think about climate change, it's very interesting. Everyone focuses so domestically, and Greta Thunberg comes to the United States and Canada, and yet 74% of electrical generation in Asia is from coal-fired plants. You would think that the biggest bang for your buck would be to go to China and say, how about we install a whole bunch of wind and solar and help clean up your grid, because there's no such thing as a no peeing section in a pool. And if Asia is going to pollute like crazy, then we should be focused where the pollution is. But now we're going to produce a whole bunch of natural gas and then export it to other parts of the world where the U.S. environmentalists are saying we don't want any natural gas anywhere in the world. How do you balance the incongruence between, like, we're just stealing from Peter to pay Paul, and we have it here, and we can do better than coal, and what do you make of that?
Yeah, I mean, I think that's the question of a lifetime right there. It's so obvious, but at the end of the day, people, all of us will do what's right in front of us. So I think to get some attention, to get votes, it's good to talk about it. If you're a local regional politician, just what we're doing here in our own backyard gets more attention than whether we are robbing Peter to pay Paul. I think the numbers out of Asia, in addition to burning a ton of coal, they're still building a ton of coal, but they're also leading the world in building wind, solar, all over the place. So yes, going to 100% renewable in the United States is not going to solve the world's climate change problems. I think that's got to be a global effort. I don't have the answer to it, but I do think everyone will act in their own immediate interest. So as long as there's a healthy rate of return, oil and gas producers in the U.S. are going to find that, and they're going to make that story, and they're going to extract that resource out of the ground and find a home for it. They're always going to be finding resistance from others who make their living collecting votes by downplaying oil and gas. But at the end of the day, to me, if there's a return on the asset, and that means there's demand for it somewhere on the planet, someone's going to figure out a way to actually make that business work. And that's why we continue to see, yes, we hear headlines. Yes, we all want a cleaner climate. But, the oil and gas industry, as long as they do it in a responsible manner, there's a demand for this product globally. And I think it's just going to continue to be developed in the correct way.
So then this brings me to the topic of the electric grid, but in particular, electric vehicles. And so we're going to go back to oil for a second, and we're going to say, okay, oil at sub 40. I mean, would you see that the break-even supply cost of an oil play in the United States using your 20% threshold? I mean, is there really any inventory that would meet that criteria from your opinion? Or I guess your opinion, the technical work you all do to come up with this, so it's not really an opinion, but you know what I mean.
Yeah, there's some core acreage out there that could do that, but you're right. You're kind of right on we're really just, squeezing blood out of the rocks here, so to speak. So that threshold, really, you do need to get above that.
So let's build on that. So oil, there's 1 billion barrels in inventory, because oil, unlike natural gas, is very mobile. You produce it, you put it in tankers, you put it in storage, you store it in swimming pools. And from the 35 million barrels a day that we let off the program with, that was demand destruction for 45-ish days, that's 1.5 billion barrels that go into inventory. 65% of oil of the 100 million barrels a day we used to produce, 65% of that was used in transportation, which is trucking and boats and flying, none of which has really come back. And at the very least, we've sort of seen a plateau, about 15 to 20% less demand. So all of this leads to a lot of oil in the world that we need to burn off inventories of before we could probably go above 40 for a meaningful period of time, short of a massive US dollar devaluation, which has a whole other thing. So all of that leads to the US will continue to decline in oil, but we continue to consume at a level, which means imports of oil will continue to grow every single year for the foreseeable future. Now, if we think about energy independence and what you said about natural gas, we have as much as we need and then some. We're going to be importing more oil every single month for the next foreseeable future. So that brings up the concept of electric vehicles. 20 million barrels a day of oil is consumed in the United States under a normal world. 70% of that is in transportation. If half the cars were to switch to electric, that's 7 million barrels a day of oil we don't need to import, but it's also 7 million barrels equivalent of natural gas we need to generate the electricity and the energy to fire those cars to move around. How does that play into the natural gas bull thesis? And does this hasten our move to electric vehicles simply because we don't want to be exposed to Middle Eastern oil? What's your opinion on that?
Well, lots of questions wrapped into there. The one, I agree with the way you've broken it all down. The one thing that does get a little tricky with imports of oil, there is that trade-off between, okay, we call it crude oil, but we all know, unlike natural gas, lots of different grades in there. So are we importing it because we need to, or we prefer that grade compared to what we're producing here locally? So that aside, hastening the move to electric vehicles, I'm kind of on the spot here, but I'll give you kind of off the top of my head. At the end of the day, yes, if you were to convert the entire fleet to electric vehicles, you'd have to massively replace that gasoline demand with electricity to charge these vehicles. Would that happen because we're trying to charge towards energy independence? I'm not so sure. I think a lot of people may talk about it that way. Some may even try to take credit for it if it happened that way. But at the end of the day, I think it comes down to the economics of, can I purchase this vehicle and actually operate it to do what I do in my daily life on a consistent basis at a competitive price? So if we continue to march there, I think the penetration of electric vehicles will continue to increase. But I don't necessarily see a just nationwide mandate or decision to just switch everything in as rapid a manner as possible. If you can build the electric vehicle at an attractive price to sell it to the population, and I think we're starting to see some green shoots of that, yeah, it'll happen over time, but it literally just has to be a decision where I'm going to choose an EV over an ICE vehicle to suit my lifestyle.
Yeah. Well, and it's, I mean, and you made the joke that it is a complex issue. All of these are complex issues because in order to make a bull thesis for one, you have to think about the alternatives, which are switching. So if oil does this, and I know a lot of people like to be talking these days about the super bull thesis in oil and that we're going to see a big run up. And me, where I land is I don't see that, because similar to the United States has all the gas we could possibly use and nowhere to do it. So we need to export it, which means we need to win over market share. Well, you think about Saudi Aramco going public at the end of 2019, and their SEC reserve report has them have a 53-year reserve life index at 10 million barrels a day. And so if you believe the world is going to transition away from your main source of revenue, you want to accelerate that so that at least you match Exxon, which has a 17-year reserve life index, which implies that the Saudis should grow from 10 million barrels a day to 30 million barrels a day to maximize the speed at which they sell their oil to the world before the world converts away and it's a useless commodity. And so in order to make a call on oil or gas and global and geopolitics, you have to be making a call on one subset and then fan it through the entire value chain. So through the value chain, we've talked a lot about Marcellus, gas demand, what it's used for. Let's talk about how the Haynesville plays in. The Haynesville is about a 10 BCF a day play if I recall correctly.
Yep.
Again, improving economics. What do you think about the Haynesville break-even supply cost as opposed to the Marcellus? And are there any other gas plays in the United States that really matter in terms of production?
Yeah, I mean, so take the last one first. There certainly are other gas plays, but none as, let's say, sizable as these dry gas plays. Certainly the Marcellus Utica takes the cake on that, and the Haynesville is the next one to look at. It's also got quite a bit of infrastructure already in place, so that's a good benefit for it. As far as its economics, I think we would put those sort of right in the middle. So they're lagging the tier 1 acreage in the Marcellus Utica, but it certainly completely outperforms all of your other. Hold on 1 second here. Do I still have you?
You're back.
Oh, you can edit that out. I had some other calls popping up on my screen.
You're totally fine. Work from home. It's the way we work.
Yeah.
There's been no dogs barking, so that's key. That's key.
Yeah. So yeah, we put it right in the middle there. It's still probably below 250 for some of its tier 1 acreage, but you can get better returns in the Marcellus Utica, and then Haynesville kind of your next stop after that.
And then every other gas play you would see is higher than 250. So is it fair to say that if we have a bull time period, oh, sorry, you were going to interject on that.
Yeah, I would say higher than 250 or oil dependent, right? So if you go to the DJ, you go to the Permian, you go to the Bakken, Eagle Ford, all of those folks, it's really more the oil story, and then the gas comes along with it. So not necessarily always have to be higher than 250 in gas, but you got to have a good return on your oil.
And so cycling back to at $40 and below, there likely aren't a lot of inventories. On scale, of course, there's always exceptions, but on scale, we don't have the inventory to grow production. Therefore, oil dependency means until oil is back above 45 or 50, associated gas won't really come. So the Haynesville has 250. I hear a lot of private equity people or people who are trying to, replicate the model, the buy and flip model, which I think is dead. But they talk about natural gas and they say, well, we've been in this bear run since really 2008, 2012. Natural gas is the next thing. I want to go invest in, pick your random basin, and I want to do dry gas because there's some small things. Am I hearing you correct that number one, maybe there's some opportunities, but it's totally dependent on exports. So if you're going to make a move, you need to have access to the export market to Mexico and internationally to really be able to guarantee that the market can take it. And number two, you have to focus on the Marcellus, because if the Marcellus grows all of the demand requirements, because it's the most economic and most capitally efficient, it's going to be even longer before the rest of the market gets to a level that $3, $3.25 sustained, that you can make money in another play. Is that a fair characterization?
It's generally a fair characterization. The only thing I would add is there is some benefit for the Haynesville with its proximity to our export destinations. So whether or not there is going to be a constraint, both basins rely on some future infrastructure projects, not to handle today's production, but if you're going to grow it, you need those projects to get in. So you could make the argument, hey, the Haynesville's got a little bit less of a mileage distance, therefore my access to the export market's slightly advantaged. But in general, I think the economics of the play in the Marcellus Utica would outweigh that. At the end of the day, yes, all these basins are competing with each other. So the Permian, when it's an oil-associated gas, the Rockies, Marcellus Utica, Haynesville, even throw Canada in there because it's a big existential problem for them to export their products. You're all competing to each other. If you think the global demand market is the destination, Haynesville does have some proximity that the Marcellus doesn't enjoy. But Marcellus, the turnaround projects that happened on the long-haul pipelines does give them pretty solid access to those Gulf Coast markets.
And I love the way you characterized it, because I think, again, and what I love about the podcast versus like a blog is you can actually dive into topics and verbalize so that there can be less ambiguity. One of the things I've said in the past is in the US, the only basin that matters is the Permian. And the reason I've said that is because the economics are the best for large scale development, and therefore as goes the Permian, so goes oil production domestically. And I've said the same for the Marcellus. And so as you see activity, you're going to see oil activity pick up first in the Permian and then on the fringes. And in gas, you would see it first in the Marcellus and then on the fringes. That's basin centric. Let's talk about companies for a second. And I don't want to put Enverus in a bad spot because I know a lot of clients are customers, but there's a difference between the commodity and the value of the company that owns the asset in the play. And there's been a large discussion, and we haven't seen that wave of consolidation for a lot of reasons. I argue valuation. But what is the catalyst for the EOGs of the world, the pioneers of the world, the oil-centric players who've really avoided natural gas to take that step and go get more gas, given if what you're talking about, the Marcellus is economic at $2, there's going to be a large market for it. Who knows how long it's going to take for oil to come back, and they have all this technical efficiency. When do you start seeing oil players buying natural gas players, and how do the valuations come to a correct relative value basis to get that done?
Yeah, I mean, I'll caveat with that. That's definitely the area for our commercial intelligence teams, which is not my expertise area at Enverus. My experience would tell me I don't see that happening anytime soon because, you know, the way I broke this down, this export story for natural gas is, you know, it's necessary. I don't necessarily believe it's a slam dunk, and it's so compelling that an oil expert is going to say, boy, oh boy, I just got to get out of what I'm doing and get into that because that is just going to explode. That said, yeah, you know, targets, you know, people might be sniffing around at players like Range and EQT, but I guess I would see it more for a major trying to add to their already existing gas expertise rather than an independent oil producer switching the lever and saying, I'm going to become a gas producer. I haven't heard much of that. I haven't seen that on the horizon. Maybe a year from now, we'll be talking a different story, but I think most of these players want to see some demand return in their core markets before they're ready to just completely take a different angle on their business.
Well, and I love that because I think related to that was that topic around the firm transport overhang and this sort of like, yeah, all these companies have built their business plan for growing markets that may or may not be able to meet it. But until they've at least met their firm transport, they actually have a liability hanging around their neck. And in order to have a bull thesis for natural gas, you need to confirm the exports. So it's almost, you know, I call it getting pregnant. And yeah, with PDC, they're already as pregnant with regulatory risk in Colorado that, to me, as an example, owning in the Permian confuses the story, and that they should swap out of the Permian and just be fully pregnant with Colorado. Same with the natural gas players. They are fully levered towards exports, firm transport, capacity out of the Marcellus, and the natural gas thesis. And so they should all consolidate amongst themselves. The oil players should all consolidate amongst themselves. And then like a high school dance, at some point, maybe they'll meet in the middle and start to dance. So,
and I think Chesapeake's an interesting story too, right? You know, Aubrey started that as a gas company. And, you know, as the years went by, you know, they in the past several years were trying to make themselves an oil company, and look, it hasn't really worked out. They probably got to get their house in order before they would be the leaders saying, hey, look, we can go back to natural gas. So yeah, there's a lot of confusion still to be worked out here.
There is. Well, Rob, I really appreciate you coming on and talking for the last 45 or so minutes on the natural gas thesis and where the tweaks in the thesis could be that make it more bullish or more bearish. But Enverus is sort of saying, look, there's a bull thesis in 2021 for all the reasons we talked about. The risk is exports, the risk is politics, the risk is pipelines. But when all of that is taken into consideration, Enverus is making a bullish call on natural gas and continues to see challenges in the oil world because there isn't really a compelling argument to go above 40. Fair characterization?
I think that's pretty fair.
Anything else you'd like to say to the Hot Take of the Day listeners?
No, it's been a pleasure, and thanks for having me.
Awesome. Well, for everyone, thanks for listening. Until next time, be safe, be good, have a great day, and bye for now.